Well, good afternoon everyone, and thank you for joining us for the webinar today on the super changes that we're currently faced with. Now, we've got a fair bit of material to go through, so in the interest of time I will get underway. By all means, if you have any questions, feel free to enter them into the dialogue box that should be on your screen there. I won't answer them straight away. I will do so at the end, just in case I run out of time, so that way if you want to listen to your answer to your query, we can do that. Otherwise, by all means, email me separately and we can I can just talk about it to you offline. So once again, welcome to this webinar on the super changes. My name is Brett Griffiths. I'm the Director of Superannuation Advisory here at Vincents. Now, basically, the super changes that we're faced with, to say the least, are fairly significant. So as you're sitting there listening to this webinar today and pondering the information that you'll see on the slides, this is probably how you'll be thinking, that there's lots of information bubbling around, and what does it all mean? Well, look, don't feel too bad about that. These changes are essentially the third biggest that we've ever had in our superannuation system, and that includes the introduction of the actual system itself back in '92. So it's quite significant. A lot of what we're talking about today is essentially unwinding what Peter Costello introduced back in 2006, albeit in slightly different forms. Essentially, that's what we're achieving. So they're quite significant changes, to say the least. So as far as an overview goes, we'll talk about the real big issues, obviously, which is this new notion of a transfer balance cap, the transitional capital gains tax measures that relate to the transfer balance cap, concessional contributions, the non-concessional contribution caps, the deductibility of contributions, transition to retirement income stream changes, this notion of catch-up concessional contributions, and finally, just a quick point on the Div 293 tax, some changes in relation to that. Now, before we sort of get underway, one thing I will just quickly mention too is that about 15 minutes ago, Labor released their position on these proposed changes. So as we're going through, you'll see where I've marked up what Labor's view on some of these points are. So what is interesting is that the government has committed to entering all these changes in one bill by Christmas into the Parliament. So by putting it in one bill, that means that if they don't get the numbers of the crossbenchers in the Senate, remembering that there's two of them that are in dispute at the moment, two of the senators are in dispute at the moment, it means that the whole bill will need to go back to the lower house for changing, for amending. If they break the measures into separate bills, it means that potentially we could get some measures through now and then some will get wrangled around in the horse trading that we'll no doubt pursue. So the political games and the political fallout from some of this will be rather interesting to watch if you're a bit of a political nerd such as myself. So the transfer balance cap. So essentially we now have this notion of having no more than $1.6 million in a pension phase. So this is what they call the transfer balance cap. And with what creates a transfer balance cap is essentially debits and credits. So typical accounting policy. Credits are amounts that are transferred in loosely, and debits are computations or rollovers out. Now, this transfer cap has no relevance to the market value, and that's a really important thing to note. Obviously, at 1 July 2017, when this is proposed to start, they will be one and the same. But as time flows on, they will become very different things. So the notion is that we'll need to essentially, as accountants or administrators of self-managed funds, we will basically be needing to account almost two separate books. So if you're a sports fan, you might remember the Melbourne Storm got themselves into trouble for running dual books with their salary cap. Well, this is essentially what we're going to have to do, so we know what your capital components are and then your market components are. The transfer balance cap will be indexed in $100,000 increments and to CPI. So at the moment CPI is only running at a few percent, so it will take some time for that to actually increase, at least 3, probably 4 years before we see an increase in that transfer balance cap. One interesting thing is that they're putting a prohibition on the segregation method used to determine for the tax exemption where you fall into the have a member that's over 1.6 million. So essentially, with an actuarial certificate, or I should go back a step. When you have a pension inside a super fund, there are 2 methods in which the trustees can determine the tax deductibility or the tax exemption of the income for supporting those pensions. One method is called segregated, and funnily enough, the other mention is called unsegregated. If you run an unsegregated model, then that's where an actuarial certificate is required to verify the percentage of the income that is actually tax exempt. In other words, you get a tax deduction for that income. If you use the segregated method, then there's no need to actually obtain an actuarial certificate. However, the process around segregation as such is, well, fairly loose, in that the trustees just need to make a determination that the certain assets belong to the certain different member accounts. So say that you have a mining share that might be worth 10 cents today sitting in the pension account, and in 3 years' time that same mining share goes up to $5. Obviously that means that mining share, because it's sitting in the account that's supporting the pension, the growth, that capital gain, if you like, is tax-free. So because it's a fairly loose system and the trustees essentially just minute what goes into the segregation or not on a as required basis, what Treasury are basically saying is that for tax purposes, segregation will no longer apply. However, you can still have segregation from an income point of view. So now we're not only running 2 different types of member accounts, but the income allocation that's associated with that between the income and the tax won't necessarily correlate. So we're having all sorts of fun and games coming up in relation to how that's going to work. Now that's only if the member has more than $1.6 million inside super. Defined benefit and market-linked pensions are actually valued based on their income. So the actuary determines their income levels each year, and the legislation, or the draft legislation, requires that for their capital base, you actually multiply that income by 16 times. So a very simple sort of calculation, and that is how you determine their capital value for the transfer balance cap methodology. So those type of pensions are not outside this scheme. So what counts as a credit for the transfer balance cap? Assets supporting a pension as at 30 June 17, the capital value of any new pensions that are commenced after 1 July 17, the capital values of the reversionary pensions when entitled. So in other words, you have a husband and wife, say in a self-managed super fund, the husband passes away and he has a reversionary pension to his wife, to his spouse. So what that means that there is an automatic entitlement for his pension to be transferred, depending on the trust deed of course, to be transferred to his wife, to his spouse. The way that the draft legislation is worded is that that will still count towards the wife's or the spouse's transfer balance cap, but she has 6 months to actually make that determination as to what they're going to do with the money. So in other words, if they're going to remove it from the superannuation environment or transfer it back to an account, to an accumulation account, so into a growth phase, but retain it inside superannuation. So there's a 6-month window there for those special circumstances. And notional earnings that accrue on the excess transfer balance amount. So in other words, if you don't take money out of super, if you have more than 1.6 million, or if you don't transfer it to accumulation phase, then there is notional earnings that are applied to that transfer balance cap, or to the transfer balance amount, and those that earning is actually part of the transfer balance cap also. So it's sort of like compound interest, if you like. It adds to the capital. And what counts as a debit? Quite simply, pension commutation and also rollovers. So if you roll money from one super fund to another super fund, that's also a debit. So in other words, you're reducing down that capital. And what else are we dealing with? So transition to retirement income streams are not included in your transfer balance cap. And I'll go through a little bit more detail later as to why that is. But basically they sit outside these new this regime or these rules. Family law payments, so matrimonial matters where husband and wife are splitting their superannuation, those essentially there's a relief in there, and now with relief you actually have to write to the commissioner and ask, so the tax commissioner, and actually ask for the relief. And if there's situations of fraud, so if there's an investment advisor that does the wrong thing, then you can write to the commissioner, ask for relief in relation to that. So in other words, by saying that, hey, I've lost $200,000 because of fraud, I would like that to be excluded from my transfer balance cap. And structured settlements. So a structured settlement is basically where someone receives a personal injury claim, so potentially an accident at work or something of the like. They're able to put money into super. Those types of structured settlements sit outside of this regime also. So to run through some examples, the transfer balance account. So here we have Alison, who starts a pension on 1 July 2017 with $800,000. Then she commutes $500,000 to a lump sum. So now her transfer balance cap is $300,000. 3 years later she commutes another $300,000 into super, and she commences a pension on this. So this is how it looks. So now her transfer balance cap is $600,000. Now during the time of her starting her first pension of $800,000, and then 3 years later her actual balance may be, say, $700,000. But however, that's irrelevant for the transfer balance cap regime. We're only looking at essentially what was used to start pensions with. So it's quite a different sort of notion to come to grips with. And indexation on the cap. So this is where it can get quite confusing, to say the least. So still using Alison, starting a pension on 1 July 17 of $800,000, and which is obviously 50% of her 1.6 million transfer balance cap. Now that's because 800,000 goes into 1.62 times 50%. So let's say that in 2021 the general transfer balance cap is now 1.7 million. Now as Alison had used up 50% of her transfer balance cap previously, she is only entitled to a 50% increase in her transfer balance cap. So rather than it going up by $100,000 as the general transfer cap has, her personal transfer cap only goes up by 50% of that, in other words $50,000. So that means that her remaining cap is $850,000. And following on from those two examples, what if Alison had unused transfer balance amount? Well, what is her unused transfer balance amount in 2021. So basically, the general transfer cap of $1.6 million plus her indexation of $50,000, because remember, she only gets 50% of that, less what she actually started her pension on, which was $600,000. So that means she actually has an unused transfer balance cap of $1.05 million. So that's basically the process that we'll need to go through whenever a pension is started to see, okay, how much can we actually start for this additional pension? So we'll need to look at what the transfer cap is, about the general transfer cap is, indexate it forward, and then determine how much we can start the pension on. Interestingly, in the draft legislation and explanatory memorandum, there is also a notion in there of a reporting mechanism that appears to me to indicate that any new pension will need to be reported to the tax office. Now, this is not unlike a system that we used to have going back a number of years ago, over 10 years ago, where the trustees or the administrator had 28 days to actually report any new pensions. Now, when we had the simple super regime introduced in 2006-07, that basically fell away, that reporting mechanism. But it almost seems to me that the more things change, the more they stay the same. So that may be making a comeback. So that is rather quickly what the transfer balance cap is all about. So there's a fair bit of real detail in there, and by all means I encourage you to go through, I suppose, the handouts that you'll get a copy of at the end of this, to go through the examples in a fair bit of detail, because it isn't exactly an easy thing what we're talking about. Transitional capital gains tax. Now this is a great thing, and out of the whole 300 odd pages of legislation, explanatory memorandums that I've read over all this stuff, probably closer to 400, this is by far my favourite quote in the whole thing. So essentially the government acknowledges that the provisions are complex and include a range of interactions with capital gains tax and other legislation. As such, the government is continuing to consider the best approach to incorporate the provisions in legislation and welcomes feedback. So in other words, Treasury doesn't know how to handle it, and they're asking industry to come up with the way to do it. Bearing in mind that the consultation process, so where Treasury released these draft documents or the draft legislation and allowed industry to comment on them, essentially was a week for each of the 3 packages that were released, which, when you consider that what was involved and to get your head around how it all works, is not very long, to say the least. So we'll see how that progresses when they release all the consultation papers. So what they're doing, or sorry, what they're proposing is we're going to have a grandfathering of capital gains tax. So if you have capital gains tax, or sorry, capital gains that has accumulated while the member was in pension phase before 1 July 2017, you're actually able to essentially sell the asset, or virtually sell the asset, and realise the capital gain and then go forward. So basically it's like a refreshing of the cost base. Now this has to be done prior to lodging of the 2017 tax return, and the fund basically must elect to do it, and when they elect, if they want to use this measure, they have to elect using the ATO specified form, which of course doesn't exist yet, and it is an irrevocable election. So once you make the choice, you can't then go, actually I want to change my mind 8 years down the track. It's just basically bad luck. So the way this is proposed is that you can either elect to pay the tax as at or in the 2017 tax return, or you can defer that tax for up to 10 years. So as I've said there, it's basically akin to selling the asset as at 30 June and buying it back. Now it only applies where a member has more than $1.6 million inside their super account, or there is a transition to retirement income stream in place. If the asset is not sold by 30 June 2027, so in 10 years, the original cost base will revert. So the interesting point there is, let's say that using my little example before, you buy your mining share at 10 cents, it goes up to $5. If you make the election as at 30 June 17 and say, yes, I want to crystallise that cost base, basically the virtual sale and the rebuy, and then it tanks and basically goes into liquidation within 5 years, you have to hold that asset for 10 years to then go back to your original cost base. Otherwise, you'll receive the cost base of the $5 amount. So it means that your carry forward capital losses will be far greater at the $5 amount than if you had it at the original amount, obviously. So there's just some interesting fun and games that can be had with the timing of selling assets now. And a key feature with all of this is, while super funds have to value their assets at market value each year, we'll be asking all of our clients, where applicable, to actually attain new valuations for lumpy assets such as property as at 30 June 17, because we want to be able to come or have our valuations without question. If we're using one that's a couple of years old and the tax office then want to question it, we've got no basis. So valuations will be quite critical, and that will also determine potentially if you have to move money into accumulation phase or not into accumulation phase, and your ability to actually make contributions going forward too, which I'll touch on shortly. So to run through some examples, say we have Carrie, who's in accumulation phase, and Andrew in pension phase. In an SMSF with one single asset, so a hunk of property worth $3 million, and they paid 2.5 for it. So there's a $500,000 gain. As Andrew's pension is worth $2 million, he basically needs to roll back $400,000 to accumulation phase. So that way his transfer balance cap is 1.6, so we're fine there. As Carrie has 1/3 of the fund, it means that 1/3 of the gain is notionally assessed. So in this example of $500,000 gain, we're talking about $166,000, less the discount that may apply. So basically they have two options. They can either add the $166,000 as a net capital gain in the 2017 tax return. Why would you want to do that? Maybe you've got capital losses carried forward. Or they can defer the inclusion as a net capital gain for up to 10 years, but they need to sell it prior to 30 June 2027. Otherwise, then the original cost base will revert. So in this case, if they hold on to the asset for 9 years and they sell it for $5 million, then their cost base will be $3 million. So between $3 million and $5 million is a $2 million capital gain. 1/3 of that is about $666,000, plus the $166,000 that we're carrying forward from the initial amount. So basically it means that when we now have a gain of $832,000 on that property, as opposed to what would otherwise apply. So once again, this is going to be some interesting times for accountants and administrators to not only keep a track of all this information, but also applying it in a strategic way with the clients. But at least they have recognised that clients in pension phase that have greater than 1.6 million have accumulated or potentially accumulated some capital gains, and then we can they've introduced a mechanism in which we can handle that at least, which is a good thing. Concessional contributions. Very simple. Basically, from 1 July 2017, concessional contributions will be $25,000 for all that are eligible. Now, at one point there was the introduction in the draft legislation of increasing the age in which you can make contributions into super without this work test notion up to age 75. The second tranche of the legislation they introduced, they removed that. So essentially, you're eligible to make contributions up to age 65 without having to work, no problems at all. Between age 65 and 75, you have to work more than 40 hours in 30 consecutive days to be eligible to make a contribution into super. And if you do so, then you're able to put in $25,000 and claim a tax deduction. So a concessional contribution is where you claim a tax deduction. Now this will be indexed in increments of $2,500. Currently it's only $5,000, and that increment and the increase or the indexation is based on this thing called a WATI, which is the weekly average ordinary time earnings. So essentially, as the average wages increase for the country, then the contributions will also increase. So they've tried to align the two there. Non-concessional contributions. So this is where you're not claiming a tax deduction for putting money into super. You're doing it from post-tax money, essentially. Currently, the cap is 6 times, the non-concessional cap is 6 times the concessional contribution cap. They're looking to reduce that to 4 times. So in other words, $100,000. Now, Labor actually want to reduce that to 3 times. So you can see the little storm cloud up there in the top right. They want to reduce that to 3 times the concessional contribution cap, or $75,000. So just bear that in mind as we have this chat. Now, you're only able to make contributions, or non-concessional contributions I should say, if the member's total superannuation balance is less than 1.6 million. So now we have a couple of new definitions to learn. We have a transfer balance cap, which is 1.6 million, and we have a total superannuation balance, which is 1.6 million. So even though they're both using 1.6 million, the definitions are different. So just bear that in mind too. So if you have less than 1.6 million, you can make a non-concessional contribution into super. If you have more than 1.6 million, as at 30 June of the prior year, then you can't put any more into super as a non-concessional contribution. So the bring forward is still 3 times, so that hasn't changed, or $30,000. And just as a reminder that the current non-concessional cap is $180,000 or $540,000 per member. So if you happen to have a lazy $540,000 lying around, you haven't put money into super in the last 2 years, now may be the time to think about that, because you won't be able to put that amount of money in one go again as a non-concessional contribution. So now we have to work out basically what the gap is between the cap and the total superannuation balance for a member. So that gap can be plugged in increments of up to $100,000. Now, before I go through an example of what I mean by all that, let me go through what this notion of total superannuation balance actually is. So at a particular 30 June, it's the aggregate of the value of accumulation, transition to retirement income stream, or account-based pension balances, plus the defined benefit pension transfer balance cap amount. So you might recall a little bit earlier, I mentioned for defined benefit and market-linked pensions, it's the income multiplied by 16%. That's your transfer balance cap. So that comes into the equation, less any structured settlement contributions. So once again, they're excluded from the total superannuation balance amount as well. So the structured settlements are excluded from the transfer balance cap as well as the total superannuation balance amount, plus any rollovers that are essentially in transit. So that are rollovers that have been paid from one fund to another fund, where it left one fund at 30 June and it hadn't arrived in the new fund by 30 June. It arrived in early July, for argument's sake. So that comes into it as well. So they're trying to remove anyone playing some funny business with the moving money around. So a couple of examples for you. So Kelly has $1 million inside a self-managed super fund and $580,000 in a retail fund as at 30 June 2018. So can she make any non-concessional contributions into super? Well, let's have a look. Basically, her total superannuation balance is 1.58 million. So as this is less than 1.6 million, she can make a $100,000 non-concessional contribution into super. So even though the gap between her transfer balance, the gap between her total superannuation balance and the 1.6 million is less than $100,000, she can still put in up to $100,000 as a non-concessional contribution. So you don't have to get it up to the dollar. You can basically go over of increments of $100,000. Now, because we have a transition phase where we're reducing, or we're going from $180,000 a year cap down to $100,000, basically we have, excuse me, we have a situation where the caps work quite differently. So you'll see on this table here, right down the very bottom, I've got the annual non-concessional caps, $180,000 down to $100,000. So what that means is that, for argument's sake, if you put in more than $460,000 this financial year, you'll be ineligible to put money into super for the 2018 financial year, as well as the 2019 if you put it in for this financial year. If you put in 180,000 but less than 460, basically you can't exceed 460 over that period, because it's $180,000 a year. So if you times that by 2, which is 360,000 plus 100,000, so that's your 3-year bring forward. So if you use all of your bring forward this year, it's $540,000. That's okay. But as soon as you trigger your bring forward and then want to put more money in, that's when you've got to go through all these rules. So I'll go through an example. Say Miranda has $1 million in her total superannuation balance as at 30 June 16. She then contributes $250,000 in the current financial year, which triggers a bring forward. So that means that now Miranda has the ability to contribute a further $130,000 over the next 2 years. So that's because $180,000 plus for the 2017 financial year, $100,000 for the 2018, and $100,000 for the 2019 year comes to a total of $380,000. If we then take away what you put in, which is the $250,000, it means that we have $130,000 left. So that's how that notion works. Now take this example, which makes it quite interesting. Say Catherine has 1.35 million of a total super balance as at 30 June 17. Her gap is $250,000 between her 1.6 and the 1.35. So she could actually put $300,000 into super right now if she wanted to. Well, yeah, in 2018 financial year, if she wanted to. However, she only puts in $150,000 in the 2018 year, so she's triggered a bring forward, and she also puts in her $25,000 concessional contribution. However, by 30 June 2018, her total superannuation balance has now grown to just over 1.6 million, so 1.605, because of earnings and the like, and obviously the new money going in. So what that means is that Catherine is now ineligible to make any further non-concessional contributions unless her total superannuation balance decreases again under 1.6 million. So using the bring forward is nowhere near as clear cut as what it previously was. Having a really good handle on the value of your super fund is going to be absolutely critical with these new rules. So with us at Vincents, we've recently moved to Class Super, which is a cloud-based accounting software that allows great access to data feeds and things like that. So that sort of data will be really important for us to advise clients effectively on where their balance sits. So once again, getting valuations on lumpy assets is going to be critical, just to see if you're eligible to make contributions into super or not. So there'll be lots of information gathering over the next few months next 6 months to basically come up with strategies to help clients put themselves in the best situation that we can. Deductibility of contributions. So this is where we're looking to remove the work test. So from 1 July 2017, basically any individual can make up the difference between their employer superannuation guarantee payments, so the 9.5% that the employer pays into super. They can put that difference in personally and claim a tax deduction in their own tax return. So basically the source of the contribution will no longer matter. It doesn't matter if it comes from an employer or from an individual. So from a practical point of view, this is an absolute godsend, because often people want to put money into super, but they have to go into salary sacrificing arrangements. Then the beck and whim of what their employer does as far as timing of contributions and all sorts of things. It's a real headache, and also for us in the industry, because we then have to see if they're eligible to make contributions or not, depending on their circumstances. So this gets rid of all that. Now, unfortunately, Labor is looking to oppose this measure, so we'll see where that one goes. So here's an example. Teresa's employer pays $10,000 of super guarantee for her in the 2018 year. She can contribute an additional $15,000 personally and treat it as a tax deduction or concessional contribution in her own tax return for the 2018 year. So that's how that's intended to work. Transition to retirement income streams. So from 1 July 2017, there are two changes in relation to these types of pensions. One of them is quite significant. So essentially, investment earnings on the assets supporting TRISs will be taxed at 15% or 10% for capital gains where the asset's been held for more than 12 months. So in other words, they're treated exactly the same as if they're in accumulation phase. So currently, they're tax exempt. So if you have a fund that is paying, that has members with a TRIS, that means that currently their income is tax-free. Going forward, that will not be the case. So this may mean that some clients want to unwind their transition to retirement income streams because it takes away some of the advantage of having it. The other difference is that we'll no longer be able to treat pension payments as a lump sum for tax purposes. So there's a little bit of a loophole that we're able to exploit, where we can treat some pensions as lump sums, which means that basically the first $190,000 is tax-free, But they're closing that loophole down. So to change from a transition to retirement income stream to an account-based pension, and therefore tax-exempt the investment income, the member needs to satisfy what's known as a nil cashing restriction condition of release. So there's 5 of those, and I've only mentioned 4 because only 4 are relevant, being attaining age 65, permanent incapacity, a terminal medical condition, or actual retirement. The 5th one is death. Now basically if you're dead you don't really care what type of pension you were getting, so that's irrelevant. But I'm going to focus on retirement because this is where there'll be a fair bit of scrutiny that we as accountants or administrators will need to apply to a client's personal circumstances, and where the tax office will also be applying a fair bit of scrutiny, I'm sure. So what is retirement? Between the age of 56, so preservation age when you're able to access your super, through to 59, it is an arrangement under which the member was gainfully employed must have come to an end, and the trustee must be reasonably satisfied that the member intends to never again become gainfully employed for more than 10 hours a week. So if the member worked for 9 hours a week, then that's fine, they're retired, so long as they don't work more than 10 hours a week. And it's important to note that the trustee must be reasonably satisfied that the member intends to never again. So a couple of things there. For self-managed super funds, the member needs to be able to look themselves in the mirror and say, am I going to be going back to work again? If they can honestly, hand on heart, say no, and everything else lines up, then they can consider themselves as retired. Or if they're only going to be working 10 hours or 8-9 hours a week somewhere for argument's sake, then they can still be classified as retired. And that's gainfully employed. So volunteering doesn't come into that. It's only if you're actually getting paid for what you're doing. Now the real grey area, essentially, or the one with the most flexibility, is this one, where the member is aged between 60 to 64. So firstly, you have to at least be age 60, no surprises there, and an arrangement under which the member was gainfully employed has come to an end on or after reaching age 60. So now the question is, okay, what is an arrangement under which the member was gainfully employed coming to an end? So basically the member must physically cease the activities for which they were employed. If the member is a director of a company, then they have to actually resign as a director of that company, and they should no longer receive remuneration for it. Now, it is possible that if they were, say, chairman of the board and they resigned as chairman and they were just a director, that still satisfies a condition of release under these arrangements. So what's the impact of that? Let's work through this example. So Owen's 62, he works full-time, and during the recent census he was employed by the Australian Bureau of Stats for more than 10 hours a week to deliver census forms, pick them up, that sort of thing, because as we all know their website didn't quite work. Now that arrangement ceased on the 1st of October 2016, so there was gainful employment, it was genuine employment, he worked more than 10 hours a week, and that ceased. It doesn't matter how long it was for, so long as it was all genuine, and it has now ceased. So has he retired? Well, basically yes. Even though he still works full-time, he can have multiple jobs. So long as that arrangement has ceased, he is retired. So in Owen's situation, his transition to retirement income stream can now become an account-based pension. So that means the earnings on that pension, on the assets that support that pension, are now tax-free. Any new money that goes into super will go in as a transition to go in as an accumulation, so he will still pay tax on those earnings. If he were to start a pension potentially that would still be a transition to retirement pension unless he can satisfy another condition of release. And this is a very interesting scenario where, once again, it highlights the importance of having an accountant or administrator that has really good records and actually knows what they're doing. So basically, Barry retired at 55, but he didn't commence a pension. He had enough money sort of outside super. He informed his super fund at the time, or the accountant at the time, so then they changed his benefits from what's known as preserved, which means that you can't access them, to unrestricted non-preserved, which means that you can actually access your super. 2 years later, he's offered his dream job and he goes back to work full-time. Now, even though he didn't start a pension at the time, he can still now start an account-based pension just on his unrestricted non-preserved benefit that's inside super, because there's no proportioning rules for this. So you may be aware that there are tax components inside super, so that it can be akin to like a death tax. They can't be proportioned. So when they come out of super, they have to come out in equal portions. The preservation rules don't apply like that. So you can actually cherry pick which ones you want. So in this case, we would choose all of the unrestricted non-preserved portion or balance, to start an account-based pension, and we'll keep the rest in another type of pension or just in accumulation. So, but even if there is 1 cent of preserved money inside that account-based pension or inside that account, we couldn't make an account-based pension. It would become a transition to retirement. So it's quite important to identify exactly what it is, start it on that amount, and then the earnings of that from the assets that support that would be tax-free. And a couple of, I suppose, more minor points to finish up. So unused concessional contribution caps. So from 1 July 2018, it's proposed that unused concessional caps can be carried forward for up to 5 years, providing the member has less than $500,000 as at 30 June of the year before they actually make the extra contribution. Now, once again, the Labor Party are proposing this measure, so don't know if it will get up or not. The notion behind it was for working mothers who basically take time off work, take a bit of a career break, and then go back to work. It allows them to basically catch up on contributions that they've missed while basically at home and off work. Now, that's one of those things where it's they still have to have the cash flow to do it, so it's a nice in theory. I don't really know if it will work as intended. If the Labor are opposing it, it might just be a case where they roll over on it. And finally, the Division 293 tax. So from 1 July 17, it's proposed that the income threshold will reduce from $300,000 down to $250,000. Now, the ALP would like that to be $200,000 as opposed to $250,000. So what that means is that this mystical figure of an adjusted taxable income, so it's your taxable income plus any clawback for capital negative gearing or losses on investments, plus your contribution, your concessional contributions. That's how you make up this $250,000 or $200,000 or $300,000 figure. So basically, if you have more than that $250,000 between those three amounts, then you will pay up to an additional 15% on the contributions going into super. So you can still claim the tax deduction and that sort of thing. It just means the super fund pays more. That's the only difference. And that's where we are. So these, as I mentioned at the outset, this is all still proposed. We have seen draft legislation. The government has committed to introducing all this before Christmas into the lower house. Then it needs to pass through the lower house into the upper house. By Labor basically holding out their position, it means that the horse trading can essentially happen before it hits the lower house, therefore meaning a quick transition. A lot of the changes that are proposed are very significant, and they will require a lot of change to systems and processes and how data is actually collected and reported. So a lot of stakeholders, being accountants, administrators of large super funds as well as self-managed funds, the tax office, have a lot of work to do if all this is to happen by 1 July next year. It will be interesting to see if it all does start then, but ultimately that's what the consultation process was about, was to see, okay, do you think we can make this happen? There seems to be some indications that some can, but time will tell. So if there are no questions, when I can't see any popping up, we might end it there. But by all means, when you have had a chance to look through the material, if you have any more questions that you want to ask, feel free to drop me an email. The details will obviously be in the beginning of the slides, or give me a call and we can have a chat about it. Because as I say, these are very significant changes to what is already a complex system that is just making it even more so. So if there's no more questions, we might end it there. And I thank you for joining us. All right, thank you very much. Have a great afternoon. Bye-bye.